Welcome to the Deep Dive. We take complex financial reports, break them down, and hopefully give you some fascinating insight.
Yeah, make it make sense.
Exactly. Today we're tackling Hasbro. Their Q3 2025 earnings presentation and press release just hit the wire, literally today, October 23rd.
And our job for you today is, well, pretty crucial. We want to get past just the headlines.
Right.
We need to understand why one part of Hasbro, the gaming side, is absolutely exploding while the classic toy business saw this planned decline.
And also clarify some of those big financial adjustments, what they really mean for the company's direction.
Yeah, there's a $1 billion difference between reported and adjusted profit we need to explain.
Okay, let's get straight to it then. The punchline right up top.
Let's do it.
Despite maybe some doom and gloom you hear about toys, Hasbro's total revenue actually climbed. A solid 8% year over year.
Yep, hit $1,388 million for the quarter.
But here's the kicker, the context you need. That growth, that entire 8%, it wasn't really broad-based, was it?
No, not at all. It was almost entirely carried by one specific segment. It really propped up the whole company result.
That's the key framing. And profitability followed suit.
It did. Adjusted operating profit also grew 8%, landing at $356 million. What you're basically seeing here is successful portfolio management in action.
Meaning?
Meaning the strength in their IP division, specifically that high-margin gaming business, was just so incredibly strong.
Strong enough to cover the other side.
Exactly. It completely masked the expected and, frankly, structural headwinds hitting their traditional toy lines.
Okay, so let's jump right into that segment then. The one, as you said, driving the bus, Wizards of the Coast and digital gaming.
You see, yeah.
We're talking Magic, the Gathering, Dungeons and Dragons here. And the growth wasn't just good. You used the word spectacular before we started.
I did, and maybe spectacular is even underselling it a bit. Q3 revenue for WOTC alone.
Yeah.
It surged an incredible 42% year over year.
Wow, 42%.
Reaching $572 million. But honestly, the revenue isn't even the most impressive part.
Really? What is?
The profit. Because this is largely digital, it's collectibles, it's high-margin stuff. Their operating profit jumped 39% to $252 million.
And that margin number is key, right? For anyone listening trying to gauge the financial health signal.
Absolutely key. Look at the margin itself. That segment maintained a, frankly, seriously impressive 44.0% operating margin.
44%?
Yeah, that single number tells you almost everything about why Hasbro is shifting its focus, its identity even.
Because nearly half of every dollar in revenue becomes operating profit there.
Exactly. They want more of that. Who wouldn't?
Now, within WOTC, the sources seem really clear on what's powering this. It wasn't D&D primarily, was it? It was one specific game having a monster quarter.
Oh, without a doubt. The engine here is Magic, The Gathering. MTG alone saw revenue jump, get this, 55% in Q3.
55% for just Magic.
Just Magic. And it wasn't just organic background growth. This was fueled heavily by their Universes Beyond strategy.
Ah, the crossovers. Bringing in outside IP.
Precisely. That strategy of bringing external licensed IP, like Marvel, into the Magic ecosystem, it's clearly working.
So what were the specific products? What was the fuel for that Q3 explosion?
Well, you had the release of Edge of Eternities. That was a core Magic set.
Okay.
But then you combine that with the huge success of the licensed crossover set, Marvel Spider-Man. That one really hit.
Right. Those premium sets always seem to do well.
They do. And you couple those big releases with, continued momentum from their backlist titles and those limited run, high-price Secret Lair drops. And it all added up on the tabletop side.
And you mentioned we can actually slice that huge 42% overall WOTC revenue increase, see where the different pieces came from.
We can, yeah. And it really shows how dominant the physical card game still is, but also where digital is chipping in.
Okay, break it down.
So Wizards Tabletop, the physical cards, contributed 35 percentage points of that total 42% revenue jump.
The vast majority.
The vast majority. But the rest, the other 6 points, came from digital and licensed gaming combined.
And digging into that 6%.
If you look closer, the biggest piece of that 4 percentage points of the total 42% increase came purely from digital licensing, not even games they operate themselves.
Digital licensing. Okay, that 4% has to include Monopoly Go, right? That mobile game has been a phenomenon.
Absolutely.
I think we need to put that in perspective. How much has just that one licensed game brought in so far this year?
It's substantial. So let's zoom out slightly. The total Hasbro gaming segment, which includes WOTC and licensed stuff like Monopoly Go, is up 27% year to date. That's over $1.9 billion.
Okay.
MTG revenue specifically, year-to-date, is up 40% to over $1.2 billion. Huge numbers.
Wow.
But that licensing story you asked about, Monopoly Go alone, has contributed $126 million in revenue year-to-date for Hasbro,
Just from the license?
just from licensing the IP.
Yeah.
That's pure high-margin cash flow. It really shows their power to monetize classic brands without making a single physical thing.
Okay, so what you see is clearly, like you said, a juggernaut.
Mm-hmm.
But it almost had to be, because the other half of the business, the traditional consumer products segment, CP, well, it faced some real headwinds.
A very different story over there, yes.
CP revenue was actually down 7% to $797 million. Now, Hasbro's line is that this decline was expected. It was mainly about timing. How much truth is there to that?
I think there's definitely some truth to it. The timing issue seems legitimate, at least partially.
Okay.
They noted the 7% drop was, and I quote, primarily attributed to the timing of U.S. retailer orders tied to later holiday shelf resets.
Meaning retailers ordered later this year.
Essentially, yeah.
Yeah.
They held back orders, maybe anticipating a shorter, more compressed holiday shopping rush. So some revenue likely just shifted into Q4, not necessarily lost forever.
Okay, maybe. But the revenue dip isn't even the main worry when you look at CP's health, is it? The real red flag seems to be the profit drop.
You got it. Adjusted operating profit for CP plummeted 32% down to $89 million.
32%. See, if it were just timing, you'd expect margins to hold up better, wouldn't you? But they crashed.
Exactly. You've nailed the structural problem there. The adjusted margin dropped significantly from 15.1% last year down to just 11.2% this quarter.
Ouch.
And that margin crunch, according to Hasbro, was driven mainly by two factors that feel much more persistent than just retailer timing.
Which are?
First, ongoing elevated tariff expense. That's a big one. And second, an unfavorable product mix.
Okay, unpack those quickly. Tariffs. Still an issue.
Still a major issue. Manufacturing costs, especially dealing with tariffs related to China, are a persistent drag. And product mix just means they sold relatively fewer high-margin things and more lower-margin things during Q3.
Right, so that margin drop feels like it could be a longer-term headache. Did this pressure hit all regions equally, or was it concentrated?
Oh, definitely not equal. Huge differences geographically in Q3.
Yeah.
North America revenue is down 8%, which kind of fits that retailer reset story.
Okay.
But the really steep drops were in Asia-Pacific and Latin America, both down double digits, 25% and 20% respectively.
Wow. Any bright spots?
Europe completely bucked the trend, actually showed very healthy 12% revenue growth.
Interesting. So the U.S. and developing markets feeling the pinch most.
Seems that way, yeah. The timing and tariff pressures look quite concentrated.
Okay, let's shift to what people were actually buying. Forget the retailer orders for a second. Let's use the point of sale data, the POS data. This tells us about actual consumer demand, right?
Exactly. POS is crucial for understanding what's resonating on the shelf right now.
So what did it show? Who are the winners and losers in Q3?
Well, the POS data shows, I'd say, intense fragmentation. It's not like Hasbro isn't selling any toys. It's just that specific IP cycles are waxing and waning.
So who was waxing? Who had growth?
Q3 POS growth was strong in Hasbro Gaming. That's the non-WTC board game side. Also Peppa Pig, Super Soaker, Beyblade, and Marvel products.
Marvel again?
Marvel again, yeah. In fact, their overall action figures and accessories category actually increased market share by 1.5 points. They secured the #1 spot in that category, holding 26.7% share. Preschool toys also gained share.
Okay, so specific licensed IP and some classics like Super Soaker still doing well. But what about the really core foundational Hasbro brands? What did the POS data show declining?
Yeah, that's where you see the challenge. The decline list includes some absolute Hasbro titans,
Yeah.
F for Y, Nerf, Play-Doh, Transformers, and Star Wars.
Oof, that's a core list.
It really is. And if you compare that list, Furby, Nerf, Play-Doh, Transformers to the gainers like Marvel and Peppa Pig.
It highlights the licensed versus owned IP issue.
Exactly. Outside of their gaming division, the core owned IP seems to be underperforming the licensed partner IP right now, at least in Q3 at retail.
Suggests they really need to invest in refreshing those core brands.
Absolutely vital for the future health of the CP segment, I'd say.
And one last piece on CP inventory. Always a worry for toy companies before the holidays. How are they looking?
Inventory is stable but expensive. Total Hasbro-owned inventory is up 6% year over year, sitting at $397 million.
Up 6%. Is that bad?
Well, the reason for the increase isn't necessarily overstocking. They say it's driven by those later retailer resets we talked about, and simply higher costs baked in, due to foreign exchange and, yes, tariffs again.
Ah, tariffs impacting inventory value, too.
Right. But context is important here. They've actually done a really good job clearing out old stock over the last couple of years. That $397 million, it's still down dramatically 53% compared to where they were in Q3 2022.
Okay, so much better discipline than a couple years ago.
Far more discipline now, yes.
All right, let's pivot to maybe the trickiest part, the financial cleanup. Because this is where I think headlines can really confuse people.
Yeah, the GAAP versus non-GAAP dance.
Exactly. You see this massive year-to-date net loss reported, but then in the same breath, the company's talking up an adjusted profit improvement. This feels like a key aha moment for you listening.
It absolutely is.
Yeah.
How can a company report a huge loss but claim things are getting better financially?
Explain it.
It's a textbook example of GAAP versus non-GAAP accounting. So under the official rules, generally accepted accounting principles, or GAAP, Hasbro reported a year-to-date net loss of $524 million.
$500 million loss.
Right. But their operational performance metric, what they call adjusted net earnings, came in at $570 million profit.
So a $570 million profit adjusted.
And that adjusted number was actually an improvement of $71 million compared to the same period last year.
Okay, so you have my $524 million loss versus a $570 million adjusted profit. The difference there is over $1 billion. What is that?
It mostly comes down to one massive item, non-cash adjustments, and the single biggest one bridging that huge gap.
What was it?
It's the single largest non-cash event on their books this year, a goodwill impairment charge.
Okay.
A massive one. They recorded a non-cash goodwill impairment charge of $1,021.9 million.
Yeah.
Over $1 billion back in Q2 2025. And it was booked against the consumer products segment.
Okay, for anyone listening, goodwill impairment. Can you just quickly explain what that means in plain English?
Sure. Goodwill is basically an intangible asset that gets created on the books when a company buys another company for more than the fair market value of its physical assets and identifiable liabilities.
So it represents things like brand value, IP value.
Exactly. Brand reputation, customer lists, expected future profits from that acquisition. It's the premium paid. Now, impairment happens when a company decides that the future value, the future earning power of a segment they bought years ago in this case, parts of the consumer products division, is now permanently lower than what's recorded on the books.
And they have to write it down.
They have to write it down, take the loss.
Yeah.
And Hasbro explicitly stated this impairment was triggered by an assessment they did after tariffs were implemented.
Ah, so the tariffs directly impacted the long-term view of those assets' profitability.
That's the signal, yes. That the future profitability of certain CP assets is now expected to be lower because of those structural cost issues, primarily tariffs. But crucially, this write-down, this impairment, it doesn't involve spending any actual cash today. It's an accounting adjustment for past decisions and future expectations.
Which is why they exclude it from their adjusted results to show the underlying operational performance.
Precisely. So once you strip out that huge non-cash accounting charge, which reflects history and tariff impacts the ongoing operational health, the adjusted number actually looks pretty solid.
And that operational health is also being helped by cost cuts, right?
That's right. They're getting real cash-based savings there. Their big operational excellence program. It delivered about $150 million in gross savings so far this year.
Okay.
Which puts them squarely on track for their big multi-year goal, hitting $1 billion in cumulative gross cost savings by 2027. They're also cleaning up the balance sheet, spent $120 million year-to-date paying down debt.
Good discipline. The only slight, maybe softening point in the financials was cash flow itself.
Slightly, yeah. Cash flow from operating activities did dip a bit, down $98 million year over year to $490 million for the year-to-date.
Why was that?
The sources just note it was due to increased use of working capital, which, often happens when you're managing those inventory resets and dealing with higher input costs like freight and tariffs. Nothing too alarming there, it seems.
Okay, so given the incredible low TC performance, the cost savings coming through, they felt good enough to actually raise their forecast for the full year 2025.
They did. A notable raise.
What's the final word on the updated guidance then?
It's significant. Total Hasbro revenue growth for the full year is now expected to be in the up high single digits range on a constant currency basis.
High single digits, that's definitely a step up from their previous guidance, wasn't it?
It was. Previously, they were guiding to up mid-single digits, so moving to high single suggests real confidence.
That's a clear signal that Wizards' strength isn't just a one-off quarter. They expect it to keep compensating for the CP softness.
Absolutely. And the bottom line forecast confirms that confidence. Their adjusted EBITDA guidance, that's earnings before interest, taxes, depreciation, amortization, a key measure of operational cash flow.
Right.
That guidance got a big boost, now expected between $1.24 billion and $1.26 billion. That's up significantly from the prior range of $1.76 to $1.21 billion.
Wow. Okay. They're clearly banking on those high rotisserie margins to deliver.
They are, and they also reaffirmed their medium-term targets out to 2027. Still aiming for mid-single-digit revenue growth on average each year and pushing for 50 to 100 basis points of adjusted operating margin expansion per year. Hashtag tag outro.
All right, so let's quickly recap this deep dive. Hasbro's Q3, it really feels like a story of successful portfolio management, maybe even divergence within the portfolio.
Yeah, two different worlds almost.
You had the explosive strength of Wizards of the Coast, fired up by that massive 55% surge in Magic, gathering revenue.
Just incredible numbers there.
And that strength was more than enough to offset the planned timing issues and those tougher structural tariff and cost headwinds hitting the traditional consumer products side.
It papered over the cracks, you could say, but in a very powerful way.
Right. And that underlying strength, primarily from OTC, gave them the confidence to significantly lift their full-year revenue outlook.
Yeah, the big picture takeaway for you listening has to be this, that aggressive revenue guidance, not just for this year, but looking out towards 2027, it seems to rely almost entirely on the continued, sustained acceleration of high-margin IP monetization.
Both cards and digital licensing.
Both cards and digital licensing, like Monopoly Go. This quarter, and especially that guidance raise, it feels like the clearest signal yet that Hasbro's identity shift.
From toy maker to something else?
Exactly. From traditional toy manufacturer to maybe a more sophisticated IP and games company. That shift is accelerating dramatically, and that's probably how you need to think about valuing them going forward.
So the big question left hanging is, can that core toy division find its footing again amidst these high costs and tariff pressures? Or is the future of Hasbro purely about the magic, both literally and figuratively, of its intellectual property?
That's the billion-dollar question, isn't it?
We'll definitely be watching. Thanks for joining us for the deep dive.